Charter Hall just upgraded its earnings guidance for the third time in a single financial year. That alone is unusual. 3 upward revisions in 12 months from a property group means the inflow machine is running well ahead of what management itself expected. The number is concrete. FY26 operating earnings per security guidance is now 103.6 cents. That is up from 100 cents, which was itself already an upgrade from the original target. Against FY25 actual earnings of 81.4 cents per security, that implies 26.5% growth in a single year. For context, Charter Hall manages roughly $74.7 billion in funds under management. 6 months ago, that figure was $71.7 billion. The $3 billion increase came almost entirely from fresh equity inflows, not asset revaluation. Financial year-to-date gross equity inflows reached $6.5 billion. That is $1.7 billion higher than the first half figure, meaning the second half of the year is running faster than the first. The share price responded accordingly. Charter Hall closed up 6.7% to $20.62 on the day of the announcement. Here is what the market narrative missed. The 6.7% single-day move was treated as a guidance beat reaction. That is the surface read. The deeper signal is in the source of the inflows. CEO David Harrison said the group added 25 new institutional investors to its platform in just 18 months. New domestic and offshore institutions, not existing investors adding to existing mandates, new entrants. That distinction matters enormously for how a holder should think about forward earnings risk. A guidance upgrade driven by existing investors deploying more capital can reverse quickly. A platform that is adding net new institutional relationships has a different compounding dynamic. The question a holder must answer is whether that 25 institution count represents the early phase of a multi-year allocation shift, or a cyclical window that closes when rates stabilize. The answer to that question runs through the budget.
On 12 May, the federal government announced the most significant property tax overhaul in nearly 30 years. From July 1, 2027, negative gearing will be removed for established residential properties purchased after that date. The capital gains tax discount structure for residential investment properties is also being restructured. The mainstream property analysis focused on downward pressure on house prices. Modeling placed the long-run price impact at 1% to 5% lower than the baseline trajectory. Charter Hall's CEO flagged something entirely different. David Harrison said changes to negative gearing and capital gains tax could result in heightened demand for higher-yielding commercial property. This is the reversal card. The budget policy that is negative for residential property investment is a direct positive for institutional-grade commercial real estate platforms. Here is the mechanism. A large class of Australian investors currently channels capital into negatively geared residential property for the tax efficiency. From mid-2027, that tax advantage disappears for new established property purchases. The capital does not evaporate, it redirects. Inflation-linked commercial leases, long-weighted average lease expiries, and institutional-grade yield profiles become structurally more attractive when the residential alternative loses its tax preferencing. Charter Hall sits at the exact intersection of where redirected capital is likely to land. It manages diversified commercial property funds covering office, industrial, retail, and social infrastructure. These assets carry precisely the characteristics that become relatively more attractive as the residential tax advantage erodes. The grandfathering provision adds a further wrinkle. Existing negatively geared residential property owners are being advised by wealth managers not to sell. That advice preserves the stock of grandfathered properties but reduces transaction volume in established residential. Lower transaction volume in residential means less capital competing for property yield generally, which tightens the relative attractiveness of the commercial alternative. The policy announcement was 13 days before Charter Hall's guidance upgrade. It is not possible to know how much of the acceleration in second-half inflows was already capturing budget-driven reallocation decisions, but the CEO named the budget explicitly as a tailwind. That is not a throwaway line in a guidance release. The unstated premise in the mainstream residential analysis is worth surfacing. Articles covering the budget focused on the impact on house prices and first home buyers. The implicit premise was that investor capital displaced from residential would exit property entirely or sit in cash. Charter Hall CEO is operating on a different premise, that displaced capital seeks yield within property, and that institutional CRE is the natural destination. Both premises cannot be simultaneously correct in the long run. Which one is being priced into Charter Hall's inflow trajectory is the analytical question that matters. Charter Hall is not a REIT in the conventional sense. That misclassification is the source of most analytical error on this stock. A conventional listed REIT owns property directly and earns rental income. Valuation is sensitive to interest rates because cap rates compress or expand with the cost of capital. Charter Hall operates as an integrated funds management platform. Its primary earnings driver is management fees on $74.7 billion of funds under management, not the direct rental income from properties it holds on balance sheet. This means its earnings structure looks more like an asset manager than a property trust. Fee income scales with FUM. FUM grows when new capital enters the platform. As long as inflows exceed redemptions, earnings grow regardless of whether underlying property valuations are rising or falling. Office leasing activity at Charter Hall jumped 20% compared to the prior half. That is a direct input into the transaction and leasing fee lines of the income statement, which sit alongside base management fees. The group recently acquired a major Sydney CBD land precinct and launched new industrial and infrastructure funds. Each new fund represents a recurring fee stream that compounds on the base FUM figure. The rate sensitivity debate that drove Charter Hall down during the 2022 to 2024 rate cycle was largely misapplied. Analysts were discounting the stock using listed rate methodology when the earnings were being generated by a funds management business. If that misapplication persists, then the stock remains cheap relative to how a pure asset manager with equivalent AUM growth would be valued. The 9% share price gain over the past 12 months, compared with 4% for the broader ASX 200, suggests the market is beginning to partially correct that misclassification. But the correction is only partial. The verification point is the FY26 full-year result, scheduled for release on 20 August 2026. That result will show whether the $6.5 billion inflow figure translates into the full-year fee income that the 103.0 cents per security guidance implies. If it does, the misclassification discount narrows further. If inflows slow in the second half beyond what has already been reported, the third guidance upgrade becomes the peak rather than an inflection. The 20 August number is the checkoff moment. Everything in the guidance upgrade, the record $6.5 billion inflows, the 25 new institutions, the budget tailwind, the 3 upgrades in 12 months, is either confirmed or qualified on that date. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.